Welcome to week 4. We are ready to start module 4, looking at federal income taxes. How much are to withhold from a employee's paycheck, and kind of continuing on from what we did the 2 prior weeks, how much is actually taxable for federal withholdings. Before we do that, let's jump into, I've got 9 review questions that you hopefully should know by now. And also let me state here, and I'll try to remind at the end, if you haven't started your payroll take-home project as of last module, you definitely should try to start it by the end of this module, by the time you're done with this week's homework. Therefore, you won't have an overload of stuff in that last week and trying to get the whole project done. And if you want it reviewed, and if your instructor allows reviews, to send it to them by email. All right, so which form is filed quarterly for FICA and for federal withholdings? Well, we looked at that. That was our Form 941. What I would do, and so right now I would go ahead, and when I'm done here, pause, answer the questions that you can, see how much you can review, and then we're going to go through the answers. So go ahead and pause now. Okay, so hopefully you've written down as many of the answers as you could come up with, and we're going to see how well you did, and then you can jot down the ones that you didn't know. When are the FICA and federal withholding deposits made? So these are made depending on your look-back period. So remember, your look-back period will tell you you'll look back for a whole year, and if you have less than 50,000, then you become a monthly depositor. If you have more than 50,000, you are the biweekly depositor. So that's the 2 typical ones. And I'm going to change this here. This one really should be biweekly. There we go. What percentages are used for Social Security and Medicare? Remember, Social Security, that's 6.2%. So hopefully you have that one pretty well memorized now. And for Medicare, it's 1.45%. And then usually the next question would be, do any of them have caps? And the answer is yes, one of them. And that would be Social Security. And for the year that we're going to be looking at in this class, it's going to be the year 2020 cap, which is $137,700. Remember, Medicare has no cap. It actually has an increase in the amount of taxes that will be taken out of a paycheck once an employee hits a high threshold of wages. Remember, for single, for basically anybody that's not married, it's $200,000. For those married filing joint, it's at $250,000. They tack on an extra 0.9%. Who pays FICA taxes? Hopefully we know this because we've done this every week so far. That's the employee and the employer. What's the earliest so this goes into our next part of the lecture last week. What's the earliest age to start collecting Social Security? Well, the typical normal age is 62. There are a few exceptions, but that's what I would be looking for in an answer, is the normal typical age without any weird exceptions. What is the latest age to collect Social Security? Well, you can start collecting whenever you want, but there's no need to wait beyond age 70. At 70, that's the highest that you can get and reap the rewards. If you wait till 75, they're not going to give you any more extra than what you would have gotten at 70. What is the normal age to collect your full Social Security if you were born in 1975? So the answer there would be age 67. For most of us in this class, it's going to be age 67. How is a monthly payment amount determined? Well, your monthly payment, that one's using that, I don't want to call this PMI, I don't know why I have that in there, PIA. Your PIA, your primary insurance amount. Remember, they went through and they said, okay, figure up your let's see here what they did. Their monthly average. What is the amount that you made averaged monthly over the last 35 years? And then they said take 90% of that, and then you put in an amount. And then, well, not 90, you take 90% of the first so much money, and then you take, I don't know what the percentages were, but there was 3 steps. I don't have those memorized. You don't need to have those memorized. because those amounts change every year. The amount that goes, how much you take will change depending on inflation. So that's why I don't have you memorize those. And you would only calculate that really one time in your life when you're ready to start collecting Social Security. The last thing that I had us do for review, and I'm not going to spend much time on this, you can check your work based on what I have below. The biggest thing here is figuring up how much to tax for Social Security for employee A, who is close to the cap. If we add an extra $10,000 onto the salary, they're going to go over the cap. So that would be step one. We then need to go to step two, and that's what I listed here. Step two, taking the cap amount minus where they're at year to date. That tells us how much is to be taxed left, and times that by 0.062. I only had us do a little mini miniature payroll register here just for these two taxes, just as a review to see how to calculate them. And then do the mini journal entry. Of course, this is the mini version. We don't have the other taxes taken out yet. And that's what we're going to do today. We're going to start, well, we're going to do that today, and module 5, we're going to start taking out federal this week and state and county next week. All right, so you can see how much the tax code has expanded from year one, back when in the, what was that? I think Amendment 16 to the Constitution. There was not that much tax code, pretty simple compared to now. It's just, and this is even 6 years ago. And there's a lot more now, just with new tax laws that have come out every year. All right, federal taxes, who pays, who hasn't, who doesn't pay. Remember, with federal taxes, same as with Social Security and Medicare, independent contractors do not take money out of their paycheck. They are, when you're self-employed, you have to pay quarterly through self-employment taxes, and real estate agents are into that category. They are self-employed, so no taxes taken out. For statutory employees, they also don't have federal taxes taken out. And here are some examples of who's considered statutory employees. However, with these employees, the FICA taxes are still taken out of their paycheck. All right, so any other type of employers do take out federal and FICA tax. So even if you work for the government still takes out taxes for you. Not for profits, you might think, oh, well, not for profits, maybe they don't pay tax. Well, you're the employee. As the employee, you have taxes taken out. So yes, you have taxes taken out. Corporations, yeah, definitely. Partnerships, everybody that works for the partnership except for the partners. The partners are done differently. They have their own forms to fill out. They're not treated as an employee for tax purposes and payroll tax. Sole proprietors, same thing. Anybody that works for the sole proprietor does have normal taxes taken out, and the sole proprietor has to pay their part. But the owner, if you are the sole proprietor, then you have to do it a little differently, because you're paying both yourself and the company's part. And you also are going to be treated like where you have your own business, and therefore you do your quarterly deposits, your quarterly withholdings. A few things that I wanted to mention here. Boy, my nose is itching today. Non-tax fringe benefits. These are items that are particularly exempt from taxes, and these would be from FICA and federal. The first one here, the de minimis. These are benefits that you would get from your employer that are just too small to calculate and to continually update, and would be too tedious to do that. So these are de minimis things where if you go and make 15 copies of a schedule and you pass out to your kid's baseball team, well, you're actually getting a benefit there that you would have normally had to pay if you would have done that somewhere else. but as long as that's a lot is okay at your work at a small amount, then you're not going to be taxed on it. It even goes as high up as company cell phones. That can be a little bit more expensive, of course. And if you use the company cell phone some for personal purposes, technically that would be taxable if you're not paying on that cell phone and you're using it for personal. But that would be too hard to keep track of. So a lot of times the company will just pay for the cell phone and then you use it mainly for business, but probably some for personal, because that probably is your primary phone at that point. No additional cost services. What this means is think of Southwest Airlines. If they have empty space available on a particular flight, it's not considered taxable if one of their employees would take a flight and along with the family is also included. Any spouses or dependent kids can jump on board there and use the additional no cost service and then not have to pay tax on that. Otherwise, that would be taxable income at whatever the normal fare would be. Let's say it's $100 one way and you had four, your spouse and two kids, they would tack on $400 to your income and you would pay tax on that. But this one is specifically exempt if you work for that company. Any discounts that you receive from your employer on goods that they say, well, the employer gets 30, 40% off or whatever it would be, that's would be normally considered taxable. It's a privilege. It's getting extra money off or free, but that's considered not taxable. If you're an employee of an educational service like Ivy Tech, and either I wanted to take more classes or my spouse or dependent kids took classes, they can do that either at a lower cost, depending on the school, or for free a lot of times. And that would be not included in your taxable income. So that's a huge benefit. That's big, big. Because if you worked at a larger school that's private, or not even larger, just a private school that's pretty expensive, maybe it's 20 grand a year minimum, and your kid got to go for free, that's a $20,000 savings that would normally have been added right into your tax, your income, and you would have had a much, much higher tax bill that year. If you don't work for an educational service, but your employer provides you classes to take and they'll pay for it up to a certain amount here. So I know that McDonald's does this. I think Walmart has started to do this as well. They'll pay for some of your schooling. That is free money for you. Absolutely free because they're paying it and you don't have to pay tax on that extra amount. The other ones here we've gone through, but it's good to go through them again. The retirement plans, you putting money aside into a 401k plan. Remember, this one is taken off of your paycheck for federal income tax purposes. Because the easiest way to remember that is it or is it not? Think about when you take money back out of your retirement plan, you then do pay tax on that for federal taxes and state. So here, that means then when you put it into it, then you're not. For FICA purposes, you are taxed right away, but then you're not taxed when you take it back out. Just kind of try to remember that back from week 2 and into the week 3. Medical plans, if you have a medical insurance plan, that money taken out of your paycheck is not taxed, so that's nice. Money put away into your health savings or flexible spending account. And then if you wanted to check any of the other fringe benefits, click on this link here, but these were the most common. Things that you would be taxed on, and these are going to be considered fringe benefits, things that the company provides to you, but that would be included in your final taxable income, like on your W-2. If you get company paid vacation, whereas they actually pay for you to go to Florida for a week, they not only are you taking vacation time and getting paid, but they're paying for the cost of the hotel or the Airbnb and your flight. Any kind of that kind of good stuff is taxable. If they pay for your membership, let's say you're pretty high up and your salary, and you sign the contract that you're going to come work, it says you're going to be paid 100 grand plus have membership paid at the local country club, that would be added into your what's total taxed. And basically anything that's not listed as specifically exempt, it is taxable. I just listed a few of the items there. Here are a few things that non-taxable federal payments. So these aren't necessarily wages that you get. These are just money that comes to you, perhaps. There's different ways the money will come to you, but this is money that is specifically exempt from being taxable. So of course, if you have to pay for any job expenses and then you're reimbursed for that in a couple of weeks, so it looks like you're getting money, you're paid by your employer, it's really just a reimbursement, so therefore not taxed. If the employer provides you some dependent care services free of charge, and it would be valued up to $5,000 or less as a benefit, free service, no tax. This is one of the ones that people get confused on. Workman's comp. If you get hurt on the job or sick on the job, and it's from the working conditions, then the money that you get paid out of workman's comp is not taxed. So that's a nice little benefit. Unemployment, though, that's the two that get confused. Unemployment is taxed. If you get free parking, the employer gives you a parking space. Typically, especially in a larger city, that's going to cost you quite a bit. And so that's free. Group life insurance premiums. So if somebody dies and you get paid a lump sum of money, or it's paid over a certain amount of time, and the policy was less than $50,000, then you get that money for free. Or yeah, you get that money for free that your heirs are paid, or that you're paid from somebody else. And then anytime the employer pays into the premiums, that's not taxable to you either. Employer contributions, you can see the caps here go down. Well, this is just, you can see the cap. This is what I was wanting to reference here, these items. Depending on if it's a 401k, the big one, then you can put in a lot more compared to a simple IRA. And the simple IRA is actually more than the regular IRA that you do yourself. That's only at $6,000, but that's money you can put aside. All right, so a few of these are going to be repeats, but that's good that we continue to go keep saying the same thing over and over, and you'll finally get it. Non-taxable wages. This is one that's a little odd, especially I think for this side of it. If you happen to pass away while you're still working and you get your last paycheck, the last paycheck will not have federal income taxes taken out, or it shouldn't. But it's still going to be taxable for FICA. So you're still paying into Social Security and Medicare even after you die. And the only reason I can really guess on that is that you could have a spouse that's still collecting, or dependents that are still collecting out of your Social Security account. But for whatever reason, it's not taxed for federal, it is taxable for FICA. Just how it worked out. All right, so cafeteria plans. These are plans that you should definitely take advantage of if your employer has them. A lot of times they'll say you can have this plan, or we'll give you a taxable cash benefit. You might as well just take the plan. You're probably going to be paying for it anyway. Otherwise, you're going to probably want health insurance. It's nice to have money put away 100% that you can use to pay medical bills and not have that money be taxed at all. Now, I actually got a question on this and in class on week 2, I believe, and I thought I had it in week 4, and it's here. What happens to that money if you put money into a flexible spending account? Because remember what we had said with an FSA, you got to be careful about how much you put aside. You don't want to put away too much, because if you don't use it in the year, you lose it. It's gone. You don't get it back. Whereas with an HSA, a health savings account, they're almost identical. Except with the health savings account, you can only have a health savings account if you have a high deductible insurance, what's considered high deductible at that time. It goes up every year for inflation. You can put money aside and it doesn't go away. You can keep rolling it over into the next year. So the question was, well, then what happens to your FSA? And the main thing that happens is to pay for the company's use of this other bank that holds the money, this plan that's set up. So again, I'll give the same scenario. We use, I think, Charge Snyder now for our FSA and HSA accounts. It's just the name of a bank. or a company that handles this kind of stuff, they don't do it for free. They're going to take our money, hold it, and then issue us debit cards that we can then pay for medical stuff. And that there's going to be some service charges in there. And the employer will pay that, needs to pay that to have that kind of a fund set up. It's just an extra expense. So if some of the money that you lose, it's going to go to help take care of some of these expenses. And then finally, these are the other items. If all of the money has been paid off, the employer just doesn't get to keep it as free money. If everything above was completely gone down to the lowest point it could possibly be, if they choose not to use the funds to increase annual coverage amount, they can return it back to you at taxable. But most of the time, it's not. Health savings account, here's that. Here's the amount that you can put aside, and here is the high deductible plan amounts, and these will fluctuate depending on the year. I don't know if they fluctuate every year, but pretty close, maybe every other year. You have to have a deductible of at least $2,800 for a family plan in order to qualify for an HSA. A lot of deductibles are that high anyway. A lot of people use high deductibles now. So that brings in this HSA, which is a good option. And then you can put away quite a bit of money, up to $7,100 if you think you're going to have quite a bit of medical bills. And that is dollar for dollar. You don't have to pay any tax on that. If the employer puts money in, great. Good to know that, or good to have that too. All right. Okay, let's, here's the, this is kind of a repeat, but how much that you can put away. Remember, taxes are taken out still for FICA, but not for federal income tax. Here's how much you can put away into a 401k, and then the extra additional amount that you can still put away if you're age 50 or over. And then the IRA, how much you can put away. You can put away, this is if you have your own retirement plan outside of work. You have it through your personal bank or through your personal retirement company. Separate from work, you can still put away, but not nearly as much on a per year basis. And then this amount is actually reduced if you actually put money into a 401k. Okay, so that's the maximum amount you can put away if you haven't put anything into any other type of plan. You can't put away a lot of money into the 401k plan and then set up a separate IRA. It doesn't quite work like that. So with the IRA, when you have an IRA, because the employer doesn't know, so you're still going to be taxed on that amount of money. Let's say you got a paycheck of $1,000 and then they took out all the taxes, and so you really only got paid $800. Well, and then you decide to put 100 of that 800 into an IRA. The employer doesn't know that you're putting it there, so they can't take it out of your taxable income. So you're going to be taxed on that 100. But then where you get it back is you take it off on your 1040 when you go and file for the end of the year taxes in the beginning of the next year. So just an overview of an IRA. We're not going to spend a lot of time on this because I spend a lot more time on this in tax class, but just wanted to go over some of the points. You can participate in an IRA if you meet one of these two options. If the company doesn't have a 401k plan option available for you and they don't put money into it for you, then it doesn't matter how much you make, you can put money into a 401k. If the company does have a 401k type option, it doesn't have to be exactly a 401k, but something similar, and your AGI is less than 64,000, you can fully participate in the IRA and put as much in as the legal limits. And then these are the phase out ranges. If you're above 64,000, you can still put money in to an IRA. If you're within this threshold, here's the threshold here. And then the threshold for married filing joint, I think this is actually, I'm going to move this. This is actually 65,000 because it's got to be the starting point here. 65 to 75, I'm going to show you here the phase out just a second. The married filing joint, it's a little higher. So if you're married, and even if you're over this 75,000, that's okay. If you're at 90,000, that's fine. You can still put money into an IRA, no problem. It's just when you get to 104,000, and then through the phase out, and then after 124, nothing. So what you do to figure out if you're in that span, how much can you put away? I give us this little example, and I put it in word form here, but a lot of times it's easier just to show it with numbers. So if you have income of 71,000, that's your AGI. And so let's say you're single, you fall in this amount right here. You fall within this span. What you want to do is take the top number of the phase out, whatever that is for that year, 75,000, subtract what you made, what you have as income, and then take whatever that is, that's 4,000, and then divide it by what's the span between these two numbers. And it's 10 grand. So 4,000 divided by 10,000, 40%. So you're allowed to take 40% of the normal by doing it with that calculation. So you're allowed to take $2,400 instead of $6,000 and put away into a retirement plan. A Roth IRA, how it's just a little bit different. The Roth IRA, you're still putting money aside. It still has the same contribution limits. The big difference is you don't take it out on your taxes at the current year. When you put the money aside, you're just putting the money aside and you're still being taxed on it. But the big difference is you're not taxed on the amount you put in or the earnings when you take it back out, which is big. You're not taxed on anything for federal purposes when you take the Roth back out. The limits for the Roth IRA, so even if you can't participate in the regular IRA, you still may qualify for the Roth. This Roth limit is for everybody, regardless if you have a employer plan or not. So I wanted to give us just a couple scenarios here just to make sure we've kind of have this down. I'll go through the first one and then I'll have you stop and try the second one. So let's go through the first one here and see what we get. Joseph, age 60. I tell us that because that's important, because he's on the older side, so he gets more of a deduction that we got to remember. Married, does not have a qualified retirement plan. Her AGI 200,000. How much could she contribute and deduct, if possible, to an IRA or a Roth IRA? All right. So with the regular IRA, if you don't have a plan, a qualified plan option at your work, then it doesn't matter what your income is. You can put away, and with the IRA, you can then turn around and deduct. She could put away and deduct the full 7,000. Because she's age 50 and over, she gets the stepped up. Well, that's not a good terminology. She gets the additional 1,000. So again, that's because A, her age, she gets the extra 1,000. B, she doesn't have a qualified plan at work, so it doesn't matter what her income is. Now, for the Roth IRA, it doesn't matter if you have a qualified plan at work or not. It still matters about your age. You're still in the 7,000 era, but she falls inside this phase out. So she needs to do the calculation that we just did. Take the top number, 206, minus the 200. So that's 6,000, and then divide it by the span. The span is 10,000. So 6 divided by 10 is 60%. So she can take 60% of 7,000. She could put into this Roth IRA $4,200, but you don't deduct any of it. That's because when you take it back out, when you retire, that and the earnings aren't taxed. You deduct now, you deduct zero, nothing now, but later on you reap the reward. All right, so now let's look at number 2 here, age 45. That's going to be important. Single, that's important. Has the option of participating in a qualified plan at work, AGI 73,000, how much can he put away into either one? Go ahead and pause now. Okay, again, hopefully you paused, you take advantage of that. You especially want to do that as we get further on in today's class. Let's look at the answer for this one. Retirement example was 73,000. He does have a plan available at work. So that brings us back up to our phase out up here. We're real close to the top number. So he can't put away much. When you do the math here, 75 top number minus where we're at now. So 2,000 divided by 10, that's only 20%. So we can take 20% of the normal amount with his age. 20% of 6,000, and we can deduct the full amount. Now, when we talk about the Roth IRA limit is higher. So he may actually, since he doesn't get to deduct very much, it's probably more beneficial for this individual to go into and put all his money into the Roth IRA. Because he's not being able to deduct much at all from his taxes, it's not helping him that much. Just put it into the Roth, put all of it in there. And then when you take it back out, none of it will be taxed. All right, one more example. So now that you've done the first two, hopefully we can do the third one and you can get it 100%. Go ahead and pause now. All right, let's go through the answers. We got age 55, so we get the stepped up amount. Single, that's going to be important, has the option of participating in her retirement work. AGI 127. All right, so when you have the option, remember it's a pretty low dollar amount. You're capped at 75,000 based on our prior problem because remember she's single. So the amount that this individual could put into a regular IRA, nothing. The Roth IRA, we can still put some in because we are in the cap zone. Go back up here to remember the cap. 124 to 139. So we take the high number, 139, subtract out where we're at. So that leaves 12,000. 12 divided by the entire span was 15. That leaves 80%. We can take out, we can still put in 80% of the full dollar amount. We get the higher amount because of our age. We can put away 5,600, deduct none of it. But the good part is it's not taxed later on. Okay, so for this one, what I wanted you to do is now, given all of the information, now we're saying, okay, this guy makes this much money. I want you to be able to determine when we start calculating the tax, what are we going to use as his taxable income? So I want you to read through this, see what you get. You don't actually have to do much calculating. All you got to do is figure the wage, and that's it. Go ahead and try that now. Okay, we have a salary of 1,500. That's going to be our starting point. And then we've got to go through for each of these and decide what we can take out as a reduction in our income. So therefore we pay less tax. 150 is taken out for medical premiums. So I would put yes and yes. So I would have started out here 1,500, and then minus 150 for both of them. They both get that. 100 taken out for the 401k and the employer matches. Well, the employer matches is just extra information right now. We don't need to know that. But for the 401k, we can take it out. We would say no, it doesn't get taken out here, but it does get taken out for federal withholdings. 50 taken out for union dues. The answer is no for both. That's still taxable money. $100 for flexible spending daycare, dependent care. Yes and yes. 100 taken out for both. 100 for the HSA contributions. Yes and yes. Take that out. The employer contributions. Extra information. Don't need to know that. $100 taken out 150 taken out for child support. No and no, cannot deduct that from taxable wages. So what the actual final pay is, hopefully what you got. FICA would be an extra 100 higher because they don't get to deduct that 401k option. And then I said, go ahead and try to just calculate Jack's pay. And I go ahead and I give you still, this will be the last time that I actually give you the federal withholdings. Every time after this, you're going to be figuring it. If we were to figure the net pay, they don't get paid very much after all of those deductions that they had. When you count the premiums and the child support and all that, and then you start taking out the Social Security tax. This is what I figured for the Social Security. So these are all the random withholdings that they had. These are the actual tax. Take your taxable, take your FICA times 6.2, take your FICA times 1.45, and then I gave us the amount for the federal. When you subtract everything, you're only left with a paycheck of $672 out of $1,500. That's not very good. All right, now we're getting into the toughest part of this week's work. So with that, I think this will be a good time, and we're going to switch video. I'm going to stop this one, and we'll start the second part with this part. So those that just want to focus on this can start with fresh video.